Struggling to pay home loan EMI? There is an option to reduce it now. The sharp rise in interest rates within the past 9 months has hit home loan borrowers the worst. For a Rs 50 lakh home loan outstanding with a 20-year tenure, if the interest rate has gone up from 7% to 9.25%, the EMI would have increased from 38,765 rupees to 45,793 rupees. That is a raise of 18%. Borrowers struggling to manage their household budget and pay the higher EMIs are actively looking for a solution that can help them reduce the impact of the sharp rise. There are many variants of home loans that offer easy EMI facilities for a limited period. Let us see what these options are and whether they really help struggling borrowers. Option 1. Moratorium on the regular home loan. A home loan EMI consists of two parts, interest and principal. There are many home loan variants that offer relaxation mostly on the principal repayment and some even on interest payment, which puts more money in the hands of the borrowers in the short term. Some lenders offer a moratorium on their regular home loan schemes to reduce the repayment burden of borrowers during the initial years. This happens mostly with home loans given on an under-construction property where the principal repayment starts only after the buyer takes possession of the property. However, few lenders offer such loans even in case of occupied properties. State Bank of India, for instance, has FlexiPay home loan that offers a moratorium on principal repayment for few years. Standard Chartered Bank is also offering interest-only home loans for the initial few years of the loan tenure. The principal repayment starts after this period. Option 2. Home loan overdraft. There is one more version of home loan that helps borrowers manage their repayment according to their incomes and expenses. It is called a home loan overdraft option. Under the home loan overdraft facility offered by banks and housing finance companies, HFCs, the lender opens an overdraft account in the form of a current or savings account. The home loan borrower can park his surplus cash here and withdraw from it based on his cash flow requirements. The interest cost of the home loan borrower is calculated after deducting the amount deposited in the overdraft account from the outstanding home loan amount. This allows the home loan borrowers to derive the benefit of making prepayments without sacrificing their liquidity. A home loan overdraft facility can be useful if you have a substantial fund inflow into your account and this money is used up gradually. In such a case, parking the money in the overdraft account may be more beneficial than in a savings bank account. Home loan borrowers opting for a home loan overdraft facility can even park their emergency fund in the linked overdraft accounts. This would help in saving their interest cost without compromising their liquidity. What are the disadvantages of these schemes? As they say, there are no free lunches. Easy EMIs have their own cost. Such loans mostly help in delaying your principal repayment, but you must pay it eventually. Borrowers should note that non-payment of the principal component during the initial years of these schemes would lead them to incurring higher interest costs than in home loan schemes with regular EMIs. The cost of delay in repaying your principal becomes steeper, especially in situations like the current one. In an interest rate increasing scenario, you never know how much more the interest burden will become if you do not pay it off today. Low EMI options have other drawbacks as well. The interest rate charged on overdraft or flexi home loan is often higher than that on the corresponding floating rate term loan. There is a loss of tax saving also. You do not receive any tax benefit from a home loan overdraft facility. Conclusion: if you can easily afford the higher EMI, there is no point in going for such loans, as these products would incur a higher interest cost than home loan schemes with regular EMIs. These easy loans push up the future costs. It is better to avoid such loans. However, if you have to go for such an option due to any compulsion, You should keep the lower repayment period as short as possible and should try to repay your full EMIs as soon as your income and cash flows permits to do so. This would reduce your overall interest cost to some extent. Thank you for watching. Please subscribe to my channel for regular updates.